Okay, so we're back here with Mako Mining, Mr. Akiba. We spoke last in October last year, and quite a bit has happened since. You ended the year with 78 million USD in cash, and you raised a bit of money also just after we recorded last time, which some people were a bit sort of worked up about, I think. But obviously, I think we sort of touched upon that possibility in the coming few months. You did it right after. But you raised some cash. You have a very good cash balance now. Know that record revenue in the closing quarter for the year, 50 million US. And obviously, I think you'll be doing record beaters every quarter coming up here, most likely. And your market cap is currently, I think, 620 million USD. This was pre-market, but that's where we're at currently. So I think we should just go through the asks as we always do. We just take stock. We can be a bit more swift on some of these things because it wasn't. I don't think that much has changed necessarily. We'll do San Albino first. So comments on the past sort of months that since last we spoke. Obviously, you have the underground startup going in the background. You're producing consistently and so on. So your comments on that, and then what to expect in the coming quarters, some sort of guidance.
Sure. I guess going back to 2025, I would consider the first half of the year to be pretty good. I mean, I think Q1 and Q2 is exactly what the mine should be doing. There was a scheduled weak Q3 that came out, and that wasn't because of like any operational hiccups. That was literally just because we had a lower grade part of the ore body to go through before we accessed some of the higher grade zones, and then we started to mine the first part of the high grade zone in very early Q4, and then the second part towards the latter half of the quarter. So we did put out our operating update for Q4 last month, and that showed, lo and behold, back to normal grades with similar throughputs. And then you actually have normal production throughputs. So for San Albino only, you were talking about roughly 9,600 ounces for the quarter, which is right around where it should be. Q1 will be probably even a little bit higher than that. So we're definitely in both of the high grade parts of the zones. And again, there's really no major difference in terms of how we're operating. It's just a question about how consistently we are in the high grade. The big difference between Q4 versus the rest of 2025 and certainly Q1 and Q4, and then even what we're experiencing Q2 is the gold price, right? So the average price received in Q4, which was actually substantively higher than the average price for the quarter, was 4,300, which even with that is substantially below where we're selling gold right now. So it does have a complete transformation in terms of what our balance sheet looks like. We'll likely disclose our financials at the very, very end of March, our audited financials for 2025. We'll give an update in terms of where our cash balance is. So it's grown pretty substantively. Just for your listeners to know, the way that Nicaragua works from a tax perspective is that there's a monthly effective alternative minimum tax that you pay, which is based on a percentage of revenue, about 3% in addition to the 3% royalty, and then anything above that's attributable to your 30% corporate tax rate is paid at the end of February the following year. So we're actually coming up from a tax payment perspective. So there will be like working capital movements in Q1 because at that point in time we have to pay 2025 tax because we're such a profitable producer in Nicaragua that all of our tax losses have been taken care of. But if you net out that working capital adjustment, it's like, well, this is a mine that's generating a lot of cash right now, and then this is in the context of an overall corporate operation that's dealing with another mine that's still in ramp up, albeit nearing completion of that ramp up, and then two mines which are in construction or in permitting, but both of which still require a substantial amount of exploration spend. So the fact that we're generating as much cash as we are, when we effectively only have about 1 3/4 operating mines at this point, it's really a testament just to not only the profitability of our assets, but also just the commodity price environment that we're operating in right now.
And how is the underground projects going currently?
So fully permitted. So we got the permit, which was a big deal for towards the very end of last year. We're finalizing our main engineering on that, and then we're starting to interview underground contractors. I would say I've given, I think, you two updates in these presentations. But the well, is good or bad. I think it's like neutral. Is that the startup for when the decline was moving has been pushed back. I think when we first started discussing it, we really should have been kind of in decline development. I would say like now, and then so I think that's been moved back to the end of the year. The good news is that we found more high grade open pit mining. So this would have been a bigger issue if that didn't happen. But the fact that we actually have exploration expenditures, I'm actually perfectly okay moving that backwards, so long as we actually have like a reasonable amount of open pit mine life ahead of us. The underground will be a pretty substantive change on how we're going to be doing our mining operations. So to the extent that we actually do have some space to evaluate this, I'm perfectly happy with delaying that decision, given the fact that we actually have open pit mining sources to supplement that.
And what's the fundamental reason for the delay? Is the choice of bandwidth allocating the team towards Moss and other things, or is it what's the main thing reason?
I think it's specifically finding new open pit resources. It's like if this was we're definitely an organization, and that may not be everybody's cup of tea, but we actually do operate often with effectively guns to our head in terms of our operations. We're effectively like a hamster running around a wheel. So if we need to make quick, impactful decisions because we're forced to, because we're constrained with areas of resource that we need to go, then we'll make that choice, and we'll put all the resources in the company to make those choices as quickly as possible. The alternative is if we have things that remove pressure from that, we're actually okay taking a breath a little bit. So this is more I don't think there's really like any operational delay, but certainly by having additional open pit resources takes some of the pressure off. So a lot of the schedule is how loudly I'm yelling at my team to get started, and right now it's sotto voce. Whereas if we didn't have additional open pit ore, that would be a different story.
Okay. Understood. And in terms of some color on guidance, what do you think investors should expect in terms of output? So not concerning gold price, obviously, but just the operative output from San Albino.
Yeah, we put our sort of final budget to the board about a month ago. The interesting part about this year's mine plan is that all 4 quarters look pretty consistent, which is, and again, it has nothing to do with actual mine plan. It's just how the geology lays. So I think 2026, for the first time ever, we're going to actually have like a relatively boring year at San Albino. Hopefully, we'll get some exciting stuff on the exploration side of things. But this is how often mining companies like to run their operations when things are stable. So I think so Q4, just because there was we weren't into both areas. We always operate with about 5 or 6 different mining phases within 2 or 3 pits. So we're always trying to get like 2 main high grade zones at any given time. So Q4 was really about maybe 1 3/4 of that high grade zone. Is a little bit of a catch up at the beginning of the quarter for that 9,600 ounces. So a reasonable investor should assume that a normal boring run rate would be a little bit higher than that going forward. With the big caveat and the big difference, you're overlaying that with a much different gold price than we were experiencing in 2025.
Well, it's not that boring with that in mind.
Right, exactly. I'm definitely excited about looking at our bank account. But actually, I'm also excited about being boring, right? So that's actually a good thing, because a little bit too much excitement in mining is sometimes not advisable.
Well, there's other items in the portfolio to get excited about, so I guess we'll move on to Moss. You did sort of communicate in one of your press releases recently that you would be expecting steady state production in late Q1, and that was quite recent. Just talk about what's been happening at Moss, since last we spoke. What was been the sort of the kinks you've been ironing out, and where you're at right now, and give some color on what steady state production actually means.
Sure. So we did put out an updated resource. We're gonna basically have our at least from a Mako perspective, our initial reserve declaration. Predecessor company did have reserves on the asset on the basis of this, likely in early Q2. That will show a pretty extensive mine life across the 670,000 ounces of measured and indicated resource that's there. So we'll go back to that in a second, but like one of the overriding things about the difference in modeling on our new resource versus what existed previously. So well, first of all, there was actually quite an extensive amount of drilling that was done by the predecessor company that was not updated as part of a reserve and resource. So the public information that was out there before when independent mine consultants had their 2021 reserve report out. If you actually just looked at that data versus how much was mined from the mine, there's effectively only about 2.5 years of mine life left on this. So I think to a certain extent, the size of our resource surprised people on the upside. So in part, that was integrating some new drilling information, but that wasn't all of it. In fact, it was probably a little bit less than half of that was based on new drilling information. The other bit was doing a fundamental remodel of what the resource was about. Being a little bit oversimplistic over here, but there's a pretty large regional fault, let's call it for argument's sake, like north-south, that runs through both sides of the resource. The stuff on the east tends to be structurally controlled within a vein. It tends to be higher grade within that vein. And the stuff to the west tends to be a disseminated stockwork zone with no real competent veining that's discernible. The fundamental issue with the IMC reserve and resource statement is that they modeled it as a single unit, right? So their geological domain took this vein, ran it straight through that controlling fault structure, and treated it the same way. And it wasn't like they were trying to fudge the numbers, if you will. But if you did that, and then overlaid that with geostatistical constraints, the stuff on the west side of the pit kind of fell apart, right? And there was no real coherent ore zone. But that sort of makes sense because you were modeling this as a vein which didn't exist. So the geostats sort of made sense if you believed the underlying geological model. When you do this explicitly from the geological perspective and actually model it differently, the stockworks actually holds together as an individual unit. It's lower grade. I mean, the reason why there were certain years of elevation production that was a little over 50,000 ounces a year was principally because they were only mining on the east side of the pit with the high grade controlled vein over here. But now that you're on the west and you actually look at this, modeling it like we do, in an explicit fashion, all of that holds together, albeit in a lower grade fashion. So there's about a 0.37 gram average ore body here, whereas I think elevation last had it probably in the 0.4 plus context. But a lot of that was just because of doing the brass tacks modeling over here by looking at this on a domain basis. Now, the caveat to that, which respects from an operational perspective, is that in order to access the higher than average grade stuff to the east and to the northeast, is that we do need to have an approval by the Bureau of Land Management to amend our current environmental assessment. There was never an environmental impact statement that was put on Moss. So we're operating on this relatively small scale EA. That should have come last year. There was delays on that because of the government shutdown. The site layouts have been approved by the BLM. Now they're just doing their final detail work to find out what the bonding requirements will be in order for us to access this. Now, in order for us to go and mine the higher grade part to the east, there'll probably be about a 6 or 7 month effective pre-strip that we're going to need to do over there while we're mining the relatively lower grade part of the deposit on the west. 2026 will be at what we would consider to be relatively steady state production from a mining throughput perspective, from a processing throughput perspective, but it will be of the, let's say for argument's sake, 8-year mine life that will come from that the reserve estimate. It will be by far the lowest grade of those 8, simply because of the permit constraints that we're operating. If we get that permit within the next 4 weeks, that will kind of imply that we'll be in the eastern side of that higher grade part of the ore body by the very end of next year. And then really starting in 2027, that's kind of when you're going to get the life of mine average gold grades. Now, the good thing about that is that even not only even where we're mining right now, but even when we were having some startup hiccups that we needed to sort out, the mine was profitable throughout, right? So it does show you that if we were, let's say in Q4 of last year, when we were operating basically at 40% of capacity at the lowest grade part of the mine, we were still making money. You can imagine now that by the end of the Q1, we're going to be at 100% of capacity, albeit the lower grade of mine. We'll make substantially more money than we were in Q4. And then by next year, today's gold prices, when you then overlay this with potentially 20% higher grades, then you're going to get to numbers that are pretty extraordinary, especially in the context of purchasing this operational mine for US $2 million.
What should investors expect in terms of an average grade for the reserve statement you're going to release? Just a ballpark. I mean, it's probably very similar.
Yeah, you shouldn't actually have too much dilute. It kind of plays with your mind a little bit, because there's a lot of modeling and choices that we need to make for a San Albino resource, where it's like the actual grade of the resource is completely different than what our diluted mine grade is. For Moss, it's a different beast. So our 0.37 average should more or less, I would say that it should more or less be the expectations for what we're going to do as the reserve statement. I'm trying to think if there's anything that would goose the data one way or the other, but probably not. I think that's probably a good first order guess for investors.
And then when you're not doing the blended average from east and west, only doing west, what would you expect the average grade to look like?
Yeah, you probably, the stuff to the west in the stockworks tends to be about 10 or 15% lower. Then the stuff to the east on the vein could potentially be running a gram plus, but when we're actually taking the vein and the hanging wall and footwall from the diluted side, you'd probably be about 10% higher than average. And then for a life of mine, it's not exactly 50-50, but it's thumb in the air, about 50-50 on either side of the ore zone. So that kind of gives you the average grade. But we're gonna need to go through the entirety of 2026 to actually access some of the higher grade part. So you're not going to actually see Moss be a 0.37 producer until 2027, but it will be pretty much the entirety of the year, and that will be pretty consistent through the remainder of the mine life in the context of that updated resource that we put out.
And you said you were at 40% capacity end of Q4, and
now or more. Yeah, so there was a few constraints, like the mining side. So we effectively did the first pass rehabilitation of the plant. That was pretty much complete in April, and then we sought out a mining contractor, which then turned into a little bit of a bidding war. So that was actually a useful thing to go. We signed the contract towards the end of June. It should have taken probably about 6 weeks to mobilize the equipment. There were some delays over in the Mexican border. We got initial kit in July, and then kind of like the remainder of the fleet started coming in October. So we didn't even have like all of the equipment on site that we needed to do this to run a steady state operation really until the very early part of Q4. And then within Q4, the two main, I mean, these aren't like big operating issues, but on the mine side, it was just making sure that we had our blast hole drills running with full availability. To a certain extent, we have 10 777 trucks on site in order to run a fleet at what will likely be somewhere in the neighborhood of about 15,000 tons a day, kind of like with our strip ratio where it is right now, maybe 16,000 tons a day. You kind of need to have 6.5 of those 10 operational, maybe six operational. We were only at above 5 recently, right? So we now have 7 operational trucks. The other 3 are getting commissioned right now to have additional backup capacity. But really, in the last, it's really only happened in the last 4 weeks. So kind of like in early Q1, the mining is more or less now up to speed. The processing side, there's a few things that are going on there. Like the first one is just we sometimes shake our head a little bit is that the way some of the things that on the plant was designed were head scratchers. So the front end of the crusher for no real discernible reason was designed too small. There was debate about whether to fix that while we were in startup at the early part of last year. We made the decision because our balance sheet was still constrained towards the beginning of last year to defer that a little bit, get started with knowing that was a bottleneck, but it was definitely a decision that at least was rational. Whether it was correct is a different story. At some point, that needs to be addressed. The front end part of the jaw crusher over at the plant, and then when you turn it on, you kind of like see where some of the constraints are over the plant. So it takes a while to get things done. I think a large part of this is that our staff over at Moss is pretty green. Right? So we took the workforce over at Moss down from 129 to 26 at its nadir. And then we've hired back up to the 87 that exists today, 88 that exists today. So almost by definition, most of the people that are operating on site do have less than 6 months experience with us. And then even with that, I would say half of them are not coming from other specific task-oriented jobs like this. So some of them are actually quite green, and it takes a while to do the training, make sure that people can be proactive, make sure that people kind of understand where operational hiccups are going to be coming before they become apparent. So those are a lot of the learning exercises that we have, and we also have like some the equipment availability that we've had on some aspects of this. So, for instance, when I talk about that front end crusher, which was undersized, in order to handle that based on the size of our operation, we need to mine, and then we stockpile a run of mine stockpile in front of the crusher. But then in order to get that into the jaw, we actually need to have a wheel loader that takes it and puts it in. And for a long time, it's not even all that hard of a piece of equipment to manage or even acquire. But I would say that 988 that we had at the front of the crusher, we probably only have like about 50% availability. And then, so we finally got another one. So it takes some pressure off over there. So those are all the things that we needed to sort out. So I would say like operations right now from a mining perspective are at 100%. From a processing perspective, we're probably about 85, 90%. And then within the next month, we'll be at 100 in both. Obviously with grades that are going to be 10% below the life of mine grades because of that permit constraint that we're operating in now.
And if you extrapolate, so with that in mind, you'll be feeding, I guess, 0.34, something like that, somewhere around there.
Mm-hmm. Yep.
And you would be doing that consistently for 9 months, basically. That would put you at about, what would that be, 30,000 ounces? 25,000?
So when we talk about rated capacity of 9,000 tons, those are short tons. So it'll be in the 20s for this year, and then the recoveries are holding up. We're pretty comfortable, even with a lower grade material. That this will be a 75% recovery facility.
Right. But when you say the 20s, I mean, 25, somewhere around there is what it should shake out to.
Yeah, for 2026 and 2027, when we're actually going to be at slightly higher than resource grade material, then you're going to actually have a 3 handle when all is said.
Yeah. Okay. That's good. Anything else with Moss? I think that should be a pretty good update. And again, you did say that the reserve and the updated project economics, which I guess is useful for investors and perhaps analysts, that will be in Q2, right?
Yeah, that'll be in Q2. I think our initial expectations was that we would have it out by the end of Q1, and then we actually had a smart board member say any any updated reserve would be treated as a material contract, and then that would cause like a revision to all of our document submission to NASDAQ. So I very intentionally in that press release on the resource said early Q2. We're not putting out any more material information in Q1. Let's get listed on NASDAQ. But yeah, we should be ready. I know our guys are scrambling to put out the actual technical report on the resource, which hopefully will be out in the next couple of weeks. And as soon as that gets done, then they'll start integrating that as part of the reserve update with the economic study that goes with it.
And then we should check in on good old Eagle as well. What's the again? We had this discussion last time. We've had some movements in sort of the timeline, I guess, for Mount Hamilton now as well, and we'll get to that next due to the changes in the acquisition terms and so on. But how are you thinking? Is the thinking still the same, basically, where when Eagle will get into the sort of build phase and so on?
Yeah, like the any delays that we've had for Eagle on the permitting side were measured in weeks. I mean, it wasn't actually all that big of a deal. The so we're so there's two things that actually need to be approved by the that have or will be approved by the government. One is the mineral agreement, which I think at the staff level has been approved. It's basically a very similar framework to what G Mining approved, but in the context of a smaller operation in terms of financial commitments and things of the sort that we have for the community and things that go with that. Hopefully that'll be finalized like imminently. That can happen any day. And then the frame of reference for our permit has been approved recently, like in the last few days. And then that allows us to kind of integrate everything and then submit our permit application, which it should be this month. I would say the very end of February. I would say on our last conversation, we had the expectation that this would be fully permitted by the end of the year. I think that's still possible. I think because that's now putting you in a normal approval process to Christmas. I think that there's potential risk that gets pushed to Q1 of next year. Maybe not. That being said, it almost doesn't really matter because it's not like we're going to do some pre-construction activities over at Eagle Mountain, but the main meat of the construction, really in the context of what we've told people since 2025. And certainly since we acquired the Mount Hamilton asset, we announced that in late Q3 of last year, is that given that Mount Hamilton is going to go first, Mount Hamilton will start the meat of construction in April of this year, and there'll be a 14-month period of construction. So it's not going to have like first gold pour until very, very late Q2 of 27 or maybe even early Q3. That kind of means our people can't really be moved from Mount Hamilton to Eagle Mountain until Q2 at the earliest of next year, towards the tail end of the Mount Hamilton construction. So even though there's again, we're talking about days and weeks of possible delays, none of that particularly matters. It's like with this, we're going to have plenty of space by the time that this gets permitted to when we're actually ready to start the construction here. At least the meat of the construction. There's going to be some relatively significant pre-construction infrastructure works that will be done this year. We'll probably be spending close to $6 million on it in Guyana this year, which will help spearhead a lot of the real construction activities. So building better bridges and roads to take in some of the larger scale pieces of equipment and kit that comes with building this plant and mine.
Excellent. So in terms of I guess, people can read the press release. It wasn't really a huge thing, but the restructuring of the acquisition terms, can you just unwrap that for people? And it was sort of a smaller edit, but why?
Yeah, so there's two components that actually, both of which still need to be approved on March 3rd, right? So there's the initial deal between Mako and Sailfish on the Mount Hamilton. So if everybody recalls what wound up happening, is that Sailfish bought Mount Hamilton from Waterton for US $40 million in cash. They got a bridge loan from Wexford to do that. And then immediately, so Sailfish was acting as agent of Mako in the acquisition, that they would vend that into Mako in return for a 5-year gold stream, 3,100 ounces a year, 20% of the spot price of gold, capped at $3,700 an ounce. There also happens to be a floor price of $2,700. And then after that, the original deal was that there was going to be a 2% uncapped net smelter return royalty on the rest of the asset, anything additional from gold, and then more importantly from a critical metals perspective down below. So that was done, and actually that economic agreement between Mako and Sailfish, while we were discussing final terms with Waterton, was really negotiated 2 months before the actual announcement of the deal. It was actually some shareholders pointed out it was kind of weird that we set like a cap price that was roughly the price of gold at the time. The only reason why that happened was because the actual negotiations of what happened about 6-7 weeks prior to the announcement, and gold price moved as much as it did. The critical metals already started to get reasonably more topical at that point in time. So this is like late Q2, early Q3 of 2025. They didn't start getting as important as it was important, but as, let's call it, topical as they were recently. So while we were going through this process, the whole design on that 2% NSR was really there. I don't want to admit this, but it was really there as an afterthought. Right? So we have a 2% royalty that's going to be on the property over here, beyond all minerals, basically just to keep both sides happy on the Sailfish and the Mako side. But I didn't really think too much about, in the context of the middle of 2025, about the political implications of having a 2% royalty on critical metals at Mount Hamilton. So it hit me early this year. We hired a political consultant, a lobbyist over here. So we made various entreaties to the U.S. government. Anything that people are seeing from the outside, I can say from the inside, it is 3 times more topical and urgent from the government's perspective, certainly to advance these projects. Whether it's capital available is a separate story, but the government's support on moving these critical metals projects are enormous. On top of that, and what I mentioned in the press release was that we have had discussions with other critical metals companies around doing something with the critical metals component on Mount Hamilton, and I didn't want what originally was an afterthought influencing any discussions or negotiations with that. So either negotiations with the U.S. government or negotiations with other companies that have an interest in U.S. domestic critical metals supply. So I basically called the timeout. Let's do something a little bit more thoughtful, which is to basically have an economically equivalent trade between Mako and Sailfish on that 2% NSR that basically leaves Mount Hamilton completely unencumbered, right? All of the gold deliveries and the extension of that gold loan that will be economically equivalent to that 2% NSR technically is now unencumbered by Mount Hamilton. It leaves my negotiations with both sides of the equation a lot cleaner. So going back to the management style over at Mako is that if new facts are presented to us, we don't mind making decisions, right? So especially when the original decision was not designed with that much forethought. Now that we actually had a time to think about what the ramifications is, then we basically call timeout, amended in an economically equivalent fashion, and then have shareholders basically vote on all of those new facts now on March 3rd. So I heard some discourse about the overall deal, about the Mako and Sailfish side. I think there's 2 components over here. There was the original financial transaction, which Mako and Sailfish were part and parcel of that original transaction, and those were the economics and the splits and the equity and the fairness associated with it. It was in one context. The amendment was really about trading that 2% NSR for something that I'm even though I'm not, I let the special committees kind of negotiate the finer points. Viscerally, I'm convinced that the trade of that 2% NSR to the 100 ounce per month at 20% of the spot for an additional 6 years is effectively economically equivalent.
Okay, I think that's a good summary. Yeah, I mean eh, and you did mention the timeline again. That's unchanged. Obviously, that will be in April. You're going to commence the construction. 14 months construction time. First gold pour. I don't think we need necessarily need to do that again. But you basically will have all of the funds available in equity more or less. You have 75 end of Q4.
Well, then to be worse, we don't have that now. We have it's more.
You're way more now. So you sort of a refresh on Mount Hamilton briefly. Like what is the capex? What is the expected production profile when you get into production and so on? Just for the forgetful.
Yeah, so we started like pre-construction activities now, like water well rehab. We're going to do some road maintenance and things of the sort. We'll finalize our detailed engineering and mine and plant design layout. I would say by the end of next month. But we told the market, which is we're highly confident this is going to be the case. This will be less than US $85 million to build soup to nuts, starting in April, which we're on target with, and it'll be about a 14-month schedule. So the very, very end of Q2 will be first gold pour, and we have more cash on our balance sheet today, irrespective of how much we generate in free cash flow from our two operating assets to fully fund Mount Hamilton as it exists right now. The only reason why we did the equity financing last year of roughly US $37 million was to make sure that we had enough of a buffer on our balance sheet that there would be no conceivable delays to Eagle Mountain. So even in the context of $4,500 gold, you were looking at our models, is that we would have been able to have enough, because we would have wound up with, if you included the remainder $6.5 million of debt repayment that we needed to do, we probably would have ended the year without that financing with roughly US $40 million in cash. And with the cash flow and free cash flow that would be coming from San Albino and Moss, we would have been able to get to a number probably higher than 85 million. And then we would have to wait for Mount Hamilton to get up and running. And then we would have to have enough cash on our balance sheet to have like a reasonable secure buffer before we start a $100 million capex on Eagle Mountain for us to be comfortable. We could have bootstrapped this without a financing. Doing it this way we take any risk of delay in trying to harvest enough financial resources internally to do Eagle Mountain. So I think inevitably, obviously with much higher gold prices, it changed the calculus a little bit. But if we didn't have these higher gold prices, I think inevitably Eagle Mountain would have been delayed by about a year. This way we took that any potential delay off the table by doing that raise.
Yeah, I know. I mean, it makes total sense. It's you guys being able to move forward with all of the assets simultaneously as effectively and not being constrained by capital makes total sense. And the dilution was very minimal. So I think it's already turning out to be a good decision. What I do want to ask again, and we sort of had this discussion a bit in the last couple of updates as well, but again, just hear your latest thinking. You've been very proactive on corporate development, probably one of the most proactive companies in your peer group that I have seen of this smaller size. Now you're getting a bit larger though. So what's the current thinking? You have a pretty saturated pipeline now, at least for build. Yeah, and again, we had this discussion. You're probably constrained mostly so by the bandwidth of the team. Them having to do one build and I go to the next build. I can't do two builds simultaneously necessarily. So, how are you thinking about corporate development now? Are you looking actively, and is there any likelihood of you acquiring something in the near future?
Yes, we are bandwidth constrained. In fact, I think that's probably the key risk of Mako at this point. So I'll come back to that in a bit. Two, we are actively looking at corporate development to combine those two previous thoughts into one. The type of corporate development that we're looking at from a buy-side perspective inevitably has to answer the question about how we increase our bandwidth, right? Otherwise, we can probably trip over ourselves. then three, I actually think there's a likelihood of us being able to execute on this, a pretty reasonable one. The risk of bandwidth is that so two things from a corporate perspective. I do think even now Mako's in a much different situation than it was 2 years ago, but even now I think we're too small for our own good. So if investors accept that premise, then we have a situation where our current human resources and operating team are basically only capable of handling the four assets that we have right now. And even with that, it's going to require actually quite a lot of recruiting to bring in new human resources to this. And in fact, we've made the decision that we need to get bigger office space in Tucson because we've completely outgrown our current office space. So we're now officially in the market for new spaces. The So to even deliver these four was going to be a challenge, but one that we were comfortable that we'd be able to overcome. To do a fifth asset, that would have been an issue. So if you think about like Mako as a constraining item, if you accept my premise that we're too small, and then you accept my premise that we can't do more, that actually is like a fundamental risk of Mako. So do need to try to kind of change the game board, or at least the pieces on the game board a little bit in order to actually be able to execute on the next thing. So we are in, whether the discussions go anywhere, I don't know. We have a few ideas on how to do that. So we have started discussions in that regard. I'm hopeful that other companies, public and private, can kind of buy into that vision as well. And if we're successful, then the likely scenario is that the next buy side type acquisition is going to be one that solves those two problems simultaneously. Is that one, getting ourselves bigger with more assets, and then being able to bring in people that are capable of allowing us as a group to execute on more than four assets like we have right now. And then in the long run, kind of like we're going to look at, hopefully, if we're able to kind of like change the game a little bit, then we can start looking at opportunities to grow from there. So basically, this would be like the next one will probably have to be like sort of a branching off point, if you will, that then allows us to look at more things, because we are very much constrained at this point, not so much financially, but certainly from a human resources perspective at this point.
Yeah, I guess how many 30 to 50,000 ounce mines do you really want to build? I mean, at some point you want to build a 100,000 or potentially multi 100,000 ounce mine. I guess that's the vision for Mako ultimately. But you have to start somewhere.
Yeah, I mean, you can see even when gold prices weren't as high as they were. I think a lot of the, let's call it the heuristic math that a lot of mining companies went through, especially gold mining companies went through, was based on laziness. They basically, just because they were able to tell their shareholders a simple story, I need to focus on 100,000, 200,000 ounce producers. I need to focus on tier one assets, whatever that means. Like everybody knows the company that I'm talking about. But it's crazy when you talk about things like that have no bearing on the underlying economics of certain transactions. Whether you're developing them internally or looking at them from an acquisition point of view, I care about doing good deals that are accretive, that generate high returns relative to the risks that I'm taking. But it's not all lazy. I think there are elements of truth for those heuristics, is that there is a certain amount of bandwidth and brain cells that people should be expending on individual assets, because very quickly your organization can reach its maximum level of ability. So I am sympathetic to, like, directionally, that you'll literally never hear me say I need to find something that generates X number of ounces a year. It's just like, that's not the way my brain is wired.
No, that makes sense. But obviously, I think you know starting from the base that you guys run your mines well, one would expect you would run a larger mine well as well. And I think that could be. I mean, look at something like Lundin Gold. That's a one mine company, and it's one of the larger gold mines, the gold companies in the world at this stage. If you find something really great of scale, obviously that's something you want to go with. You need to get your valuation up a bit more, I think, before taking on something a bit more sizable. But I think
Sure.
we'll get.
You can find me like a 10 gram, 11 gram deposit that generates 450,000 ounces a year. Do it.
Yeah, and buy it in the next year, snag it
Right,
from
yeah,
one of the
exactly.
companies.
Right, exactly. Maybe a little bit of a smaller market cap than 20 billion, but certainly you can understand actually like it's an interesting thing because like I think everybody kind of understands the risks of operating in a single jurisdiction with a single asset, not just politically, but just operationally. So you can think about their particular board. I'm sure they did look at other assets, but it comes back as like when you have something that's special, it's like it's hard to pull the trigger. There could be very good reasons why you want to branch out, but you always come back to, do you actually want to do that?
And again, finally, the US listing sounds like it's imminent, since you said you were going to publish this upcoming Mount Hamilton or no Moss reserve statement and so on in early Q2. So listing is very soon. I take it.
Yeah, exactly. We're going to need to have the shareholder vote first. But I think we got some additional feedback from NASDAQ. I think it sounds like we're on target to be approved this month, and then we'll try to thread the needle. Is that when we are approved, we have unless they make an exception, we have 5 business days to list. So we'll try to try to guide them. Can you please give us approval like right around our shareholder vote, so we don't need to get like a special dispensation. So hopefully we'll have a listing right after our shareholder vote on the 3rd of March. But I still do need to have like the final approval from not only NASDAQ but the SEC.
Okay. All right, Akiba, I think we'll say that we're satisfied there. I think it's pretty good update here. So we'll be back, I think, probably in 3-4 months again, and we'll do the gambit again and see where we're at. Best of luck in the meantime.
All right, great. All right, thanks. All right, thanks, Gorm.